All right, we are live for midday RTD Q&A. Excited to have returning guest, Mr. Lior Gantz, the creator of wealthresearchgroup.com, and one of my favorites to have on the show to just basically get a chance to tap into his wealth of knowledge and expertise as an investor in these markets out here to see what's going on and get his analysis on what we should expect for the future. So, Lior, welcome back to RTD Q&A, my man.
Hi, thank you very much.
Well, I appreciate you taking time for me, man, on such short notice to join me and to give us your thoughts on where we're at and where we're heading, man. And so last time we talked, I think it was at the middle of fall or something like that, and it was QE stimulus election craze at that moment. But now we're in a new administration, stimulus through the roof, and we got a lot of silver news, we got Bitcoin news, we got all types of stuff. But I want to start on the silver side of things because I think that's something that's very telling for what I guess your average retail investor might be most concerned with on this channel here, and its actual physical possession of silver as well as all the paper stuff. So let's dive right into that, man. So the failed silver squeeze, and so I want to talk about that. It's not over with yet, just the beginning, I believe. Give us your thoughts on that stuff, man.
I think what happens with the paper markets and silver is that because of the past 10 years, with the spoof trading, both with JP Morgan, Barclays, other banks that were involved, after that 10-year investigation that the CFTC did, and the $960 million fine for JP Morgan, I think this whole controversy regarding bullion banks and how they create large sell and large buy orders to spook other traders from either buying a huge chunk of silver or selling a huge chunk of silver. I think that is something that's mainstream. So it's not only within the silver bug community, it's or just the precious metal community. It's now gone to everyone. And once it hit Reddit and Wall Street Bets, they put forth all of these reports that are real. It's true. The paper manipulation has been proven in silver, but to call it a silver short squeeze is where they got it a bit wrong. In 1979, when the Hunt brothers, the two oil tycoons, tried to corner the silver market, they borrowed about $3 billion on very low credit, and by the time they were done, they warehoused about 33% or a third of global physical supply of silver, which is an incredible achievement, right? Yeah. The price of silver went to $50, and just as with GameStop and other stocks that were that brokers had to stop trading on, that's what happened in the late 70s with silver, but it was the government that actually came in and said no long contracts, only short contracts of silver. Imagine the Hunt brothers in that situation. And then they also told them to unwind their position. There was a big Silver Thursday, very famous Thursday trading session where silver just got decapitated because there was no long contracts, only short. So we know that with commodities, unlike stocks, this is something that the government can easily assume their role or their responsibility in trying to make sure that a commodity isn't manipulated as one security. Okay, so that's one thing that's important. But here's the parts where the short squeeze did not work. One, all commodities trade at a very big leverage to the underlying supply, same as paper currency in your ATMs. If we all go and try to get them at the same time, it's about 6% that exists in most modern Western countries. So it's impossible to actually go and do that. If everyone tries to get their cash savings, there isn't the actual paper to do that because the system isn't built in that sort of way. Right. And the same thing with silver. Now, with silver and other commodities, why they do that is because these paper contracts, these derivatives, these futures, and all these other products, they allow for companies that mine them to hedge. They allow for companies that, for governments that make large 10-year orders of silver into the future to hedge their purchases, etc. So it's done for a good reason, but it is abused for greed. So that's the bottom line of these paper markets. Now,
watch this real quick, if you don't mind. So it's used for a good reason, but then also
it's built for a good reason.
Built for a good reason.
It's used,
but yet, as of the way things are now, it's basically suppressed the true nominal price of those metals in relation to the amount of paper that you've mentioned that's out there that has caused more harm than good for investors, especially.
Yes, it's been abused. In other words, instead of just reaping the rewards of having a very stable, free, and transparent market in silver, they've used the fact that that there's a lot more paper than real physical supply in order to make trades on it that only exist because of these paper markets, right? But there isn't such a big short position on silver. It is very concentrated. In other words, there are 5 to 8 big players that short silver, but it's not like with GameStop or any of these other stocks that hedge funds believed will not make a recovery from because of their obsolete business models, where they had more than 100% of the float in a short position. This is not the case here. There is a sizable short position in silver, but definitely something that's not difficult to cover. So that's one thing. The second thing is when you try and squeeze these, there's trying to squeeze the physical supply, and they did that. They for sure did that, but I don't know how beneficial that is, because all that ends up happening is that bullion dealers run out of physical supply, and their premiums go through the roof, which makes it hard for other people to buy. But nothing happens with the paper markets. They're like decoupled.
Yeah, but watch this. As the premiums increase, as I always mentioned before, there has already been a disconnect from the paper rigging system, where the spot price might be $27 a day, but to go down to my local coin stop, it's already $40 for an American Eagle. So I think that trend will continue regardless of what they do in the paper game, because the goal, of course, is to keep the whole paper system intact. But yet the bullion side of things, people are actually becoming more aware of the importance of actually holding silver as opposed to investing in those, futures and things of that nature. So give us your thoughts on why people are choosing the Sprott PSLV as opposed to the iShares SLV, because that looks like the next trend where people are trying to get out of the iShares and into the PSLV.
Yeah. PSLV is 100% backed. We know that. Whereas iShares and these other platforms on the COMAX, they're most likely at pretty severe leverages to paper. So that in normal times, that doesn't matter that much. If you look at the performance of the PSLV or the iShares, you'll see that their performance is pretty at par with each other no matter what's happening. But it is sort of an arrangement you make with yourself. What do you really want to own? Do you want to own this type of product where the fees that you're paying are for the same people that you despise? Or do you want to lift and edify and strengthen the PSLV, which is run by people that come from the resource market and manage people's money honestly with a 1-to-1 ratio, etc. That's one thing. But those are, and there are people that like the physical. Those have, to me at least, that's a different thing. I both own the physical ETFs and the physical hold in your hands, because the physical hold in your hands are just part of my cash savings portfolio. I don't intend to sell. I just intend to own the amount of silver that I put in my head that I need to own. And then PSLV is more of a trading for me. If I think that Today the price is X, and it will be X plus 30% in 20 or 30 weeks, or in less than that, etc. Then I would trade it on the paper markets, because why not? This is not a long. Okay, so that's one thing, and then you can also do options and mining stocks and whatnot. So I think different goals. Here, my goal is to save and to have a long-term position in physical silver. And here, my goal is to take advantage of what I think is an opportunity for higher prices in silver. Going back to my and by the way, if you go to wealthresearchgroup.com/squeeze, we did an A to Z on this entire thing, how it started with GameStop, what happened, how it reached this epic proportions. It's a very good download report that goes over all of these and more. And I think the most important thing about it is it shows you why there's a fundamental bull market starting with silver and other industrial commodities. Silver being a quasi-industrial, quasi-precious metal mineral. So I think that's really important for people to grasp. We have entered a very strong bull market in commodities ever since. Do you remember oil going negative $42 a barrel on the day before expirations of options? And we believe that was the bottom for the 11-year bear market in commodities. If you look at the charts ever since, it looks like we're right. What I think is happening is we've entered a decade where a lot of the catalysts that work in favor of commodities are in place. And it's funny because some of them existed in the 70s, other ones existed in the 2000s, and now they almost like merge all of them into this decade. So it could even be a stronger commodity super cycle than the one in the 70s and the one in the 2000s. You've got.
Let me ask you a question real quick. As far as this upcoming decade, where you're seeing an increase in the bull market rather than commodities, for silver in particular, that's, I guess, a lot of viewers are really concerned with and excited about, in a good way and as well as in a bad way. Price wise, what do you see? So we hear people say $30. Once it breaks 30, 35, then at that point it's just off to the races. But what type of environment will we be in at that point where they lose control of silver, which appears to be the only metal that hasn't really returned to its prior all-time high?
I think the end of the bull market will be where you see these crazy blow off top moves. But I think we're a few years away from that. So for now, what I see is that silver is a very important industrial metal, thousands and thousands of uses, and not enough supply. So there's an annual supply deficit in silver, and we're entering a decade where more silver will be consumed because of EVs, solar panels, and just growth in China, growth in the United States, where millennials are now a third of the workforce. But by the end of the decade, they'll be 75% of the workforce. And just remember, none of them own cars. None of them, well, not none. You know what I mean? It's
a very small portion, right?
Own cars, and a very small portion have bought their first homes. And there's a migration to like single family homes again. A vast majority of them have not gotten married or had children. So this is very much like the mid 70s to late 80s, that 15-year period where the baby boomers were doing the same thing. They were getting into the workplace. They were building their careers, building their families. And remember, these were very, very prosperous times for the United States. And I think that's coming back. The growth that was lacking in the 2010s, when these millennials had nothing to do with the workforce, and the boomers controlled the workforce, but they already had homes, cars, everything. They had everything. It was saturated. Everything they wanted, they owned. Now you see a whole new generation, even bigger than the baby boomers, coming in, and that's big growth. Same with the millennials in China. and those are very big. They have now the biggest middle class in the world. They're going to have the biggest economy in the world, and they're in the same situation. They need a lot of commodities, and now these countries don't trust each other, so each country is going to fight for their own commodities. There's a lot of restrictions on ESG, or just anything that has to do with environment. So that raises the price of these commodities, because you need to make sure you're not polluting, and all these regulations are very costly. So you've got that, and then you've got deglobalization. What we saw in 2020, you saw the end of globalization. The first thing that came to my mind in March of 2020 was, okay, so all these countries are going to meet and they're going to figure this out together, and they never met. Each country was blaming the other one. Each country took a different path. Before we got on the air, you asked me about where I'm at right now, and how different this place is than other countries in terms of everything. And I think this is deglobalization. Each country is going to want to be dependent on itself and not dependent on China, and that's something that's really going to affect prices for commodities, and the rebuilding of infrastructure in each and every country. So you've got all these things that are really good for silver, and all you have to do is look to the past and see what happens in previous bear markets, bull markets for silver. So 70s, it went from $1.92 when it was freed up in 1971 to about $50. Let's say it doesn't repeat that 2,500% move, because that was obviously from very suppressed prices back then. You had the 2000s, where it went from about $4 to $50. So that's a 1,200% return. And now you have a new bull market that started around 12 an ounce, and it's barely doubled. So I think there's a lot more to come for silver. I don't see a reason why it won't shatter its previous all-time high, being that 23% of all currency in circulation was created in 2020. So $50 is not really something to look at and say, my God, silver 50, that's going to be insane. No, think about it. The amounts of silver that are in every item that assumes silver is very minuscule. And even if silver is at 50, these industrial companies that need to purchase it, that won't change the end product's price by a whole lot. And if it will, then at some point they will pass on the cost to the consumer. So I don't see any reason why silver shouldn't be at 50. Shouldn't trade at $50 if market forces drive it there. And when they do, these paper manipulations, they don't work when there's real demand and price discovery and whatnot. These companies like Apple and big solar panel manufacturers, big EV manufacturers, they won't come in there and try to replace silver with other minerals that can't do the job as much as silver can. So I think that's
No, so I was going to switch gears a little bit, because on this commodity bull cycle, a lot of that has to do with the rising inflationary pressures, and so we have a lot of activity in the bond market, and so inflation is a concern there with the rising rates. Apart from today, it looks like, but we got 1.9 trillion coming any day now, and more to come, and so inflation. Commodity prices are on the rise, and a lot of it has to do with the idea of investors looking for safety, as well as a lot of those funds trying to find a safe haven type of place to land. Give us your thoughts on this inflationary pressure and how it will probably be problematic this upcoming decade for millennials or whatnot, given this shifting in what I call our monetary system. I believe it is.
Inflation is a lot. A social self-fulfilling prophecy. So the more people talk about inflation, and they are, the more it's likely to occur. Because the more you talk about it, the more you're saying, okay, well, if there's inflation, let me go out and spend right now on something. And it becomes a self-fulfilling prophecy. And so the more people, more millennials understand the topic of inflation, which is this is the first time they're getting properly introduced to that. the more it will actually bring inflation.
Yeah.
I do not foresee any major inflation issues, but I do foresee that what we've had in the past decade, where it was about 1.6, 1.4, etc., on the gouge that the Federal Reserve uses, I don't see any issues with it going up by about 60 to 80% from there. So 1.4 to 1.6, going up to about 2.2 to 2.8, which is above the Fed target of 2%, and it resonates with their plan to keep it hot, as they call it. So I think that is realistic. That is important, because if that happens for a few years, then you really start seeing purchasing power lost.
Yeah.
And you start making changes in your personal lifestyle. And I think that definitely is coming.
Yeah. Now let me interject real quick if you don't mind. And so you mentioned the Federal Reserve measurements and Bureau of Labor Statistics with their numbers, 1.4, 1.6. But then you have the alternative measurements, John Williams from StatOstats, as well as the Chapwood Index. They would all lead us to believe if you use the older mechanisms for measuring inflation that included energy and food and things of that nature, stuff that we really use, then we're already 6, 7, 8% overall as far as the real number for inflation. Now, that's the disconnect again, where we're told this number, but in the streets here with the price of food or whatever and things of that nature, it's a lot higher. So do you see that disconnect actually becoming more recognizable by Main Street? Because they're Jerome Powell, Janet Yellen get there and say everything is fine, but in my neck of the woods, people are they're not falling for that anymore.
Mike, with that one, because I've heard this argument for about a decade. What I do is I just look at my own life, and I look at what I spend on, and has it changed or not? And has it changed more than the average income in my economy? So I don't know if it's 5 or if it's 8 or if it's 3. I know that for the most part, people do complain that a lot of things are getting out of reach.
Right.
And what I don't like is that what the things that get out of reach are the things that people really need to start their lives with. So education, which should be affordable.
Yeah.
If you want people to be part of the workplace, be part of society, etc. These are things that the government intervened in, unfortunately, and their prices are insane. And I think that's a shame. With what happened in the past decade, because growth was so low, people were willing to pay so much more for assets. Because if you're lowering your expectations, if you're like, I'm willing to make only 2 or 3 or 4%, then what you're saying is I'm willing to pay more for an asset. And that's what happened in the past decade. I don't think necessarily that inflation is what created this bull market in equities or in real estate, because both have been really hated for the past 10 years. Even though it's a phenomenal bull market, you actually see a net outflow of in equities, and you see a shortage in housing in America, because there was so much trauma from 2008. This is actually the first time that both equities and real estate are liked, because the millennials have come in and they love equities, and they now love real estate as well and get into real estate. They don't have that trauma from 2008 as much as the boomers do. So I think in
your opinion, are those equities and real estate, are they in a bubble to where they're overpriced to where it should be of concern for people, in your opinion?
I think that there are bubbles in certain niches, for sure. The overall market, if you look at interest rates, no, it's not in a bubble. It's just very expensive. We live in an expensive world right now in terms of equities and real estate.
Yeah.
Because expectations are low for growth, and interest rates are either 0 or negative. So if I can earn 4%, I'm willing to take it. not personally, but as a pension fund or as an insurance company, these or sovereign wealth funds, they don't have access to the deal that I look at, where you can get paid 8, 9, and 10% interest rate on loaning to big institutions with very low default rates. So I got into in 2020 some debt. I lent money to big real estate projects. I'm receiving 8, 9, and 10% like clockwork. That is not available to a sovereign wealth fund with $10 billion that they need to deploy. Just, you know what I mean? Okay, yeah. So they are the ones buying up these government debt at 0% because they have no other choice. They can't just sit on cash. So they're willing to pay they're willing to lend for 0.6% or 1%, etc. For the rest of the world, they're looking at equities, obviously, and getting into those. I think this will continue because governments, for the most part, if interest rates rise, they will be so unproductive if they have to service the debt at higher interest rates that it will start to chop into the social safety net like Medicare, Medicaid. You cannot run. You can run $1 trillion deficits in America because you pay only $500 billion a year in interest payments, and they can service that. Now, if interest rates just rise a little bit from what they are, that's another $500 billion. Yeah. Now, those $500 billions they stack up. You can't just do that. And you're not living in a vacuum as the United States right now. And so, yeah, I think there's going to be a lot of pressure on central banks to monetize bonds to make sure that they're not rising that much. I don't know if they'll achieve that or not. If they'll achieve that, then I think that equities are not in a bubble. And equities, in my opinion, they will go into a bear market because that's what happens naturally. There will be a bear market after this probably final rally that we're going to see in 2021 right now, and we're going to see like an air leaking out of a tire. You're going to see like a year and a half of prices just going down 10, 15, 20%, 25%. A lot of people are going to think it's a correction, just keep on buying. I think it's going to take like a year and a half to 2 years for this to deflate and come back down for the markets. I think in the end, there might be like a last puke where people are like, oh my God, I'm sitting on this loss for a year and a half. I'm just going to sell. And we'll end up with an overall loss in the big equity, in the big indices of perhaps 30, 35% overall in like a year and a half to 2 years span here. Yeah. Not before we rally one last time, though.
Now, so this rally that you're mentioning that is going to continue on, and then it's going to cool off or back down some. Is this a result of this trillion, 1.9, and whatever else is coming, or how? Yeah. Where's the rally going to come from? You think
1.9 trillion is going to help it. Infrastructure is going to help it. The fact that we haven't reopened yet is going to help it because it's going to price in the reopen. But once all of that is done, Mike, once 1.9 trillion is passed by the Senate in 2 weeks, the infrastructure program is announced. They announced that they're probably not going to raise taxes on you in the first 2 years of the administration. Once all this good news is announced, what's next? All this has been going up because of stimulus checks and massive intervention from central banks. Once all of that is done, what the market has nothing else to look to the future and say, by God, there's still so much more coming, and that's it. Those are the last of the buyers that are out there. There's so many new buyers that are coming in for the first time and willing to risk money in the equities for the first time. I'm just getting personally. People that are in my life and have never bought a stock are texting me that they've opened a brokerage account. It's real. The last of the buyers are coming in. They're gonna be part of this one final major rally, and I don't want to time it, but it's coming. It's literally the last of the buyers are entering, and so we're done. I mean, we've had 12 great years. What else do you need?
And that's the thing, and that's what's most concerning is that we've been rallying since the great financial crisis, 12 years now.
Yeah.
And a lot of that is quantitative easing and the stimulus and all this excessive currency creation driven that has created this euphoria, as you've mentioned, that can't last forever. And my concern is when it ends, that will lead to a correction. And of course, a lot of people, and even the former President Trump mentioned that under Biden administration, there's going to be a crash like we haven't seen since the Great Depression type of environment. And so far, Trump administration is probably batting 4 out of 5 on true predictions on what he anticipated this new administration to actually bring into fruition. And so the last one would be this last crash, which is going to be a game changer for the world, I believe.
Okay. I personally see it more as an unwinding. It's going to take 1.5 to 2 years. And my result in a 50% decline in the NASDAQ, so what? I mean, the NASDAQ has gone up 100% in the last 3 years.
Now, watch this. Harry Dent. Everybody know Harry Dent. He's, good for saying some things that, you take him with a grain of salt. But he's not alone in saying that he's anticipating 70, 80%. Like, is that a possibility, in your opinion, to have a 70, 80% correction, crash, or whatever you want to call it?
It's definitely not a correction. It's that's a major crash. Look, the S&P 500 is worth about $30 trillion. So when you say that you're anticipating a 75% decline in the S&P 500, you're looking at $22 trillion wiped out. That's 2.5 times 2008. So just remember, you need something epic to make that occur. All we have is a really expensive market. We don't have anything above that that's embarrassingly dysfunctional. So I would just say the markets are really expensive. If growth comes back into the picture, then there is a lot of deflating to do, because in a world where the economy grows 4, 5, and 6%, then equities do not deserve to be as expensive as they are. Okay, so in a world like that, we can trade at 15 or 20 times earnings and not 33 times earnings, and that is a 30 to 35% decline in equities that will happen over time. And I don't refute that. I believe we're going into a very high growth decade throughout the world and in the States as well. A lot of growth is coming. There's so many houses that need to be built for the millennials. There's a very tight housing market. There's a boom in tech. There's a boom in manufacturing. All these cities like Houston, New York, Chicago, LA, all these cities do not want to depend on China anymore. And about 1.5 to 2 hours outside of their cities, they're going to build huge manufacturing hubs that will supply the city with fresh goods and products that will come from America, not from halfway around the world. These things are coming. These things are already in motion, and they will require automatics, robotics, automation, AI, cloud. All these things are new jobs. They require many new skills, many new people, many new communities to be built in these areas that are not built right now. A lot is coming. And so when there's more growth, there's more inflation, interest rates rise. I'm not saying that they will do what they did in the 70s. I don't think that that's coming. I think that we're just moving to a world where interest rates are going to be just a tad more normalized. Inflation is going to be a tad more at the historical averages, and stocks are going to be more at the historical averages. Real estate is going to be more at the historical averages, and we're just going to deflate. That's all we're going to do. We're going to deflate a little bit in the next few years in terms of equities and real estate and whatnot. But in terms of loss of purchasing power for the dollar compared to other currencies, that's where you might want to call it inflation. You will see a lot of loss in purchasing power from the dollar towards other currencies, because all these other countries, they saw what happened in March of 2020 when their dependency on the dollar almost cratered their economies. So they want to see their own currencies stable and strong. And we believe that the 9-year bull market in the DXY ended in March of 2020. And we've entered like a 6 to 8 year bear market in the dollar. So a lot more is coming for dollar bears.
Yeah, so no doubt between now and the end of this year, the money supply, the overall units that will be brought into existence, i.e. the Federal Reserve System, as well as every other government on this planet, central bank is going to have to try to, because like you mentioned growth, you anticipate growth. Me personally, I anticipate a growth in money supply to try to create what would have been considered natural growth. So now they're going to try to create it via the stimulus, QE, and all those other things, which ultimately will squeeze purchasing power out of the hands of individuals, taking us in towards that central bank digital currency realm. And so I want to talk about, as it says here, Bitcoin is delegitimizing the USD. And so the de-dollarization process is well underway. We have the creation of CBDCs, which is their attempt to create a cross-border payments and networks outside of the SWIFT system. All that stuff is underway. So I believe all this stuff is heading us in that direction. And so give us your thoughts on, this whole Bitcoin craze and how I believe personally, it was given to us as a way of easily transitioning us and accepting a digital solely based monetary system in the future. So share your thoughts with us on that matter.
I don't think we're going to go into a fully 100% digital. We're always going to have paper. We're not always, but definitely in our lifetimes, paper money will continue to exist. I think what's happening with the U.S. dollar is that it's just the banking system is antiquated, and it's just not up to par with the way that the world is moving right now. We need instant transactions around the world. Bitcoin provides that. The banking system does not provide that, and therefore there's a room for legitimate cryptocurrencies, definitely ones that have nothing to do with any government, are good. They will coexist. And so I think the way to price Bitcoin is to say, okay, how much money or how many transactions volume-wise will happen on the blockchain of Bitcoin every single day? And if it will be in the trillions, then the entire ecosystem is worth, let's say, 20 times that daily average of transactions, and therefore you can divide that by 21 million and get to your fair price. But the fair price always moves. If there's more acceptance and less regulation, bad regulation, etc., the price always changes. It's like the internet. If you and I, Mike, own a part of the World Wide Web, we own a part of a system that transacts about $4 trillion a day. It has a lot of value, but nobody owns the internet. But Bitcoin people own. So it has enormous value. But if you look at it only from the narrow perspective of it's just digital gold, then you lose a lot of the other parts of it. It's the first decentralized way to transact around the world. It won't be the last. It's far superior to a lot of the things that are existing right now. I don't think you should chase the price higher. That's not what I'm saying. But I do think that if you understand it, then whenever it has a big decline, it's a good entry point. Like after it had a decline from 20,000 to 3,000, where were you? You know what I mean? So I think that's where I'm at with that. And the more it gets adopted and legitimized, and more people accept it and buy it, and institutions and corporations, the more it's going to succeed.
Fair enough. So let's get to some questions. I want to make sure I open up to the audience. And if you feel like you have questions, feel free.
I have about 2-3 minutes.
Okay, and I'll thumb through the chat real quick and see if there's any thoughts out there. feel free to just highlight at Rethinking a Dollar to stand out, and we can ask the questions, and we'll go from there. So let me see here. Let me see. Please, says please ask about graphene. I'm not. Yeah. So it's a question back up in the thread. It says, I don't know. I don't know what that means.
The mineral graphite.
Yeah, I assume so. I don't know. It just literally says that. So.
Okay, graphite is a mineral that's part of the commodities that are experiencing growth and whatnot. Not too sure what specifically there is to say about graphite.
Yeah. So So other than just it being out there. Oh man. So let me see.
It's been hot for years. That's all I can say.
Yeah, I haven't even really dived into it, so I'm not sure. What else? So it doesn't look like no questions on the surface after the crash, whatever. So anyway, so I'll try to have some questions ready for you next time we have you on the show. But Lior, man, it's always great to have you on and get your analysis and thoughts on where we're at. And so we will see how this all plays out because it's going to be interesting. We're only in the second or just the first day of the third month. We got 9 more, so it's going to be interesting, man. So I appreciate you for joining us and sharing your thoughts and whatnot. For those that might be coming across you for the first time, can you point them back to where you do your work at?
Yeah, we publish a free newsletter 3 times a week. Wealthresearchgroup.com is the website. On the homepage, that's where you can sign up for the free newsletter. Mm-hmm. Basically, what it tries to do is congest the 6 to 8 hours a day that I both read economic assessments and news and speak with companies' CEOs and do my own investments into a 5-minute article that touches all of it. The idea being that we're all busy and that we need to congest the most important parts 3 times a week to stay engaged and updated. And we also cover specific opportunities if I see them and invest in them personally.
All right. So we have a question here, which I think is a good one. It says, sure. If equities aren't in a bubble, then what happens if the Fed switches from QE to QT?
Well, if interest rates rise, then prices of equities in general tend to trade at lower valuations. Mm-hmm. So it would be quite reasonable to assume that if the Fed starts to tighten, then equities will start to trade at lower multiples. Mm-hmm. I would say that anything that you think is in a straight line in economics of finance, avoid that type of thinking. So even though historically tightening leads to lower multiples on stocks, that doesn't mean that will happen this time around, but certainly higher interest rates create more options for investors than just equities. And what ends up happening is that usually there are lower multiples on stocks. I would just say I don't think that QT is going to result in a crash 100%. And I think that QT is going to be so gentle when it comes.
So do you think they're going to be able, the Federal Reserve will be able to unwind their balance sheet given its current, where it's at now, and then where it might end up by the end of this year? You think they'll be able to unwind it?
Not this year. I don't think there's any intention to do it this year. No.
Yeah. Now, I'll be surprised if it's even a part of their plan to unwind it into this decade. So
definitely not this year.
But Lior, man, it's great to have you on. Appreciate you. Stick around for a quick second, and I love to talk to you off air. But other than that, everybody, hope you've enjoyed this RTD Q&A. If you have, hit a thumbs up button, share that. Make sure you guys go visit Lior, wealthresearchgroup.com. And I will look forward to having you on more interviews later. Enjoy your rest of your day.